It's Brian Preston, the money guy.
Let's transition into 50-year-olds.
All right.
Because I resemble too much of the 40s, but I'm getting really close to celebrate, to getting to this point. And it is, we titled this Celebration or Panic, because it is one of those things where I want you to kind of vision plan and think about what you expect your retirement to be. And this is not daydreaming anymore. But you better be fine tuning the plan. Right. I mean, this is beyond the daydreaming, because we're going to be talking about, hey, are you taking on too much risk, to get the growth? Maybe you do need to be having that decision to know, what does the asset allocation look like? It is also, this is the decade I want you to start feeling like you can and should be debt free. I want mortgages paid off. I don't want any credit card debt, because truthfully, you should not have that even in your 20s and 30s. But there shouldn't be student loans. There shouldn't be mortgage debt. You should have debt freedom. And also, I don't want you waiting until your 60s to build memories. I mean, I'm always amazed at how many people have this. It's like they're putting on the fridge a picture of themselves when they're 65. Don't wait until then. You need to be building memories through all decades of your life. Make sure you're using that moment to celebrate your successes.
And look, this is likely going to be that time where perhaps you want to make sure that you have surgically planned for what retirement's going to look like. This is a great time to think about hiring a professional, taking the relation to the next level, getting someone to come alongside you to help refine that plan, because some of the stuff gets a little nuanced as you get into your 50s. So from a cash flow perspective, this is one thing that we see so often, is that your kids are likely adults or almost adults. Have you begun thinking through, are my little chickadees ready to actually fly out of the nest? Am I going to be able to get my kids off of economic outpatient care, or are they still going to be a budgetary item for me even well into adulthood?
Yeah, I mean, we see this trend. I mean, this was one of the things listed in the Millionaire Next Door as an indicator of success, of becoming a millionaire. You do want your children. That's why I would focus on, hey, we talked to a lot of college kids when we were in Athens a few weeks back. Help guide your children into good majors so they don't have tons of student loan debt. And if they do, they can pay it off because they have good careers coming their way. Try to get your children to be independent. It is so important. And I do want to focus on, because we want you to be debt free. Get out of all debts at this point. Fully own your life. It is hard to say you're financially independent when you have a ton of encumbrances hanging out there with debt. You want to be completely debt free.
From a risk management standpoint, there's a chance that in your 50s, this is likely where you want to start looking at long-term care. When you think about your genealogy, is it likely that there will be some sort of end-of-life care for you? If that's the case, then long-term care is probably a good time to, in your 50s is probably a good time to start looking at that, because it's not going to be so cost prohibitive in terms of waiting too late, but you're also not going to pay for it for 30 years likely before you need it. So if you're someone in that donut hole, 50s is probably where you want to start thinking through that.
Life insurance, I think this is one of those things where you might be, it's definitely worth measuring. You might be getting close to self-insurance because, I mean, if you got the kids out of the house, they're out of college, they're in their own careers, you've got enough pot of money saved up to where you're fully financially independent, you can start looking at some of those term life insurance policies to see if you're truly on self-insured. By the way, even if you are, don't just throw away those term policies, because a lot of them realize you paid premiums for years where you're probably getting the cost of that insurance is much higher than what the actual annual premium is. Look at that. You might not want to just throw them away. You might want to go ahead and let them finish out their term before you just don't re-up and get more life insurance. But it is definitely something where you should measure twice, cut once on determining how are you from a risk management standpoint.
When it comes to investing in your 50s, your retirement runway should really be starting to take shape. And not so much that, remember, in your 20s and 30s, you were focused on your savings rate. In your 40s, you needed to know your number. In your 50s is where you want to start stress testing. Will this plan actually work? We've shown this to you before. But one of the ways we like to do this is through a Monte Carlo analysis, where we have a number of different variables saying, what do we think our probability of success is if we retire this year, if we wait to take our pension until this year, if we start drawing some Social Security here? You want to make sure that you have stress tested your plan early enough that you give yourself some time to make adjustments as needed if you need to make adjustments. So in your 50s, this is where you really want to start thinking through, do I have the right portfolio and plan in place to provide for that great, big, beautiful tomorrow that I've been looking for and waiting for.
I think this is a take that I think a lot of people would be like, why is this under investing? I want you to not, because we talk about the financial stuff, but you also need to be figuring out and thinking about what does your life look like from an interest and hobbies post-work life. Because, we've done some interviews on what do happy retirees look like. They have a life outside of work.
It's not
and I think
just work.
that is,
That's right.
so you do need to make sure focus on planning what hobbies, what interests you will have post-retirement so that you can go ahead and start investing in that to make sure what that moment and what that happiness factor is for you.
When you're in your early 20s, 30s, and 40s, you really start thinking about your risk tolerance. How much risk can I handle? How much do I feel comfortable with? As you get into your 50s and on, then you have to start thinking about risk capacity. How much risk should I be taking? Do I have enough time to be able to recover before I need these dollars? So in your 50s, you need to take a long, hard look at both your diversification and your asset location. Where are my assets put? And when I retire, when I reach financial independence, where are my dollars going to come from? Because those decisions are likely going to have a long-term impact on the viability of your plan.
Bo, I want to talk about a little bit we talked about risk reward, making sure you're not taking too much risk, especially because if you've won the game. But I do think it's one of those things, tax planning wise, this is a lot of people, especially if you're part of that FIRE movement, because I think anybody who's retiring early, and that's 50 somethings, this is a primo opportunity to where required minimum distributions start at 72. Yep. Your earned income is gone completely away because you've retired. Roth conversions in your 50s is an incredible planning opportunity. And
then you want to know about some key dates because a lot of big things happen in your 50s. The first one, at age 50, you become eligible for catch-up contributions, both on the IRA as well as the 401k side. The government lets you save a little bit extra. At age 55, if you are retired, if you stop working and you were employed with your employer in the year that you turn 55, you can actually begin drawing from your 401k. It's a little bit earlier than the normal pre-tax deadline of 59 and a half. So if you are somebody who's thinking about retiring in your 54th year, you may just want to think through it because waiting that extra few months or extra year might give you that little bit extra, be able to access the dollars earlier than you might be able to otherwise.
Yeah, and then I think 59 and a half, obviously
is
important.
The IRA, that's right.
IRAs, it's one of those things. Yes, there's some complex annuitizing accounts where you can get to it even earlier, but these are the key dates, 50, 55, and 59 and a half to pay attention to when we are considering things from a tax planning. Estate planning wise, it's more likely you're going to have full wills that were drafted by an attorney. You will need to be also very aware of how do revocable trusts that work outside of, your wills, how do, because that's a revocable trust, a living trust. These things and your asset titling will become so important as you are in this level of success that you better be very deliberate in making sure your wishes and the most optimum structure is paid attention to so you don't get yourself in a big whoopsie situation.
One of the things we see, this happens so often, is when someone becomes a new client of the firm of Bound Wealth, they'll come in and we'll say, hey, let us review your estate documents. And we'll kind of go through a review and we'll say, okay, hey, we understand, this to be true and this to be true and this to be true and this to be true. But we noticed, this said you're supposed to have a revocable trust over here, but you got a joint account. And why is it supposed to be that way? And you have these trusts, but you have individuals as beneficiaries. You want to make sure that all the different pieces of your financial plan, of your financial life are talking to one another. You want to make that your estate plan is appropriately reflected inside of your investment plan. They need to work together to be a nice, cohesive, strategic, long-term plan.
Guys, hopefully you've seen there's lots of benefits to the financial planning pyramid and going through and thinking about this. It's a lot more complex if you're going to do it right than just spending less than you make, making sure you control debt.
That's right.
And, and last, just creating an automated plan. There's going to be different things you want to do by different decades. Make sure you're not neglecting your financial life. And that's why we have the great We've put lots of work. We've road tested this thing, seen lots of people create success. Financial order of operations. If you want the free downloads, moneyguy.com/resources. If you want to go ahead and get a deeper dive to accelerate your success, go to learn.moneyguy.com. We do have courses as well as tools like our net worth tool that will also help accelerate that path. Pay attention to these things and you can create success for yourself.